Okay, good morning to everybody. We are going to begin ANPEC section, special section. This time we have the pleasure to have here Jesus Ferreiro that will present his presentation. The title is Challenges and Perspectives for the Fiscal Policy in the European Union after COVID-19 Economic Crisis. Well, Jesus Ferreiro has a very broad CV. He's professor of economics at University of Basque Country in Bilbao, where he organizes every year a very interesting post-Keynesian conference. He's also member of the Center for Economic and Public Policy of the University of Cambridge, associate member of the NIFIT University of Porto, and the Forum for Macroeconomic and Macroeconomic Policies fellow also. That network in Germany. Well, he has a lot of his interest is research interests. The fields of macroeconomic policy, labor market, international economy, financialization, institution, and of course, post-Keynesian economics. I forgot to mention that Jesus is also member of our group, not Brazilian, international group, that Structuralist Development Macroeconomics Research Group that Professor Ferreiro and I are the coordinator of this group. We have the pleasure to have the participation of Jesus. So in the name of ANPEC, I would like to welcome you and thank you for taking part of this conference. Okay.
Thank you very much, Luiz Fernando. And first of all, what I want to show you is my deep gratitude to the organizers of this event for having me invited to participate as an invited speaker. So I'm really happy and honored to accept this invitation. As you have seen from my title, although I will focus on the past, present, and future of the fiscal policies in the European Union in the period that is we start to open as soon as possible once that the COVID pandemic and the subsequent economic crisis ends. I will be not only talking of fiscal policy, but I will also talk about monetary policy. And the reason is that the fiscal policy rules that are now in force in the European Union and in the Euro area are strongly connected and related to the general macroeconomic policy strategy. One of its pillars is fiscal policy, and the other pillar is the monetary policy developed by the European Central Bank, by the ECB. So in this sense, the challenge that is affecting to the working of the fiscal policy in the European Union and the possible reforms that can be approved in next years in these rules is quite closely related to the changes and the reforms that has been recently approved in the field of the monetary policy. So in this sense, I will talk about the logic of these strategies and how it has been varying along the time since the beginning of the process of the monetary unification in Europe. So to start with, I must start my intervention saying that at the beginning of the last year in 2020, the European Union embarked on a process of reviewing its overall macroeconomic policy strategy and economic governance framework. The economic recovery that began in the middle of the previous decade, around 2013-2014, was showing at this time clear signs of exhaustion. Indeed, the economic growth rate in the European Union in the year 2019 was only 1.6% and 1.3% lower in the case of the euro area, with countries like Germany, for instance, growing at a rate of 0.6% and Italy at a rate of 0.3%. Indeed, in 8 countries like Ireland, Greece, Spain, Italy, Cyprus, Luxembourg, Denmark, and Sweden, unemployment rates in this year were still higher than before, recorded before the burst of the global financial crisis. At the year 2020, just before the outbreak of the pandemic, there was a broad consensus in Europe on the need to review the general macroeconomic policy framework in force in the European Union, a framework that was based on the monetary policy strategy that is designed by the European Central Bank and the fiscal rules of the Maastricht Treaty and the Stability and Growth Pact, in order to ensure, and this will be the objective of these reforms, to ensure a return to a long-term path of sustained and higher growth. However, at this time, I am saying the months of January, February 2020, there was no consensus on the nature of the problems that were affecting the effectiveness of this strategy. In the case of the monetary policy, some people argue that the problems of the ECB monetary policy were explained by the existence of temporary problems, who in turn were derived from the difficulties of applying the traditional monetary measures based on the management of interest rates in a new environment of low interest rates and inflation rates close to zero, and also defined by the potential new episodes of financial instability. However, other voices, other people raised the need to reformulate in a radical manner the objectives and instruments of monetary policy, because they were arguing that the mentioned problems of low equilibrium interest rates and low inflation rate were not temporary or transitory, but permanent, something that could lead to unconventional measures of monetary policy becoming an ordinary instrument of monetary policy in Europe. In the case of the fiscal policy, the debate was of greater depth between those in favor of maintaining the fiscal rules in force, with the only need to adopt reforms to ensure the compliance, and those who defended the need for a radical reform of these rules. The latter were arguing that a large part of the economic problems of the European Union and the euro area, mainly the low economic growth, were direct consequences of the austerity policies derived from these rules. Although the review of the monetary policy strategy ended last month of July, the review of the fiscal policy strategy process was early suspended because of the outbreak of the COVID-19 pandemic. The crisis generated by the pandemic led to the suspension of the fiscal rules in force in the European Union in view of the imperative need to tackle the economic impact of the pandemic through the unprecedented use of fiscal stimulus measures. The aim at this moment is to finish this review process by the late 2024 or early 2023. Where are the reasons behind these differences in the timing of the review of the fiscal and monetary policy strategies? The truth is that the approval of the new monetary policy strategy has been a simple and easier process. On the one hand, monetary policy in the euro area is in the exclusive hands of the ECB, which, being independent of the national and European authorities, has the capacity to design its own strategy of action, always under the provisions of the European treaties. On the other hand, a second element that has been easier, this reform of the monetary policy strategy, is that during the last decade, the European Central Bank has been implemented an unconventional monetary policy based on cutting interest rates at 0.0% in September 2014 and 0 since March 2016, and also on the adoption of massive liquidity injection measures in the banking system, on the granting loans to banks for very long terms, and through the design and implementation of financial asset purchase programs for banks, basically through the purchase of public debt securities. However, the situation is much more complex and difficult in the case of fiscal policy. The lack of a centralized and a single fiscal policy at the European Union level means that fiscal policy is implemented at a national level, with national fiscal policies being coordinated through the fiscal rules approved within the European Union. It should be borne in mind that tax rules in the fiscal rules in the countries of the European Union must be approved by qualified majority and in many cases by an unanimous criteria, which is a complication given that we are talking about different countries, now 27 different countries, that have different visions on the role to be played by fiscal policy. On the other hand, the pandemic, as we will have the opportunity to show later, has meant a radical change in the orientation of the fiscal policy of European countries with respect to what is established in the fiscal rules in force. In any case, it should be noted that the European authorities in February 2020 fully supported, that is at the beginning of the review process, were fully supporting the effectiveness and the validity of the fiscal rules in force in the European Union. As you can see in the transparency information copied from the document of the European Commission published in February 2020, for the European institutions, the European fiscal rules had fully demonstrated their effectiveness, requiring only minor reforms to guarantee that the main problems that were affecting the compliance with the rules could be corrected. Which were these problems? Mainly they were the existence in some countries of a public debt higher than the reference criterion about the size of public debt, that is set at the level of 60% of GDP, and the adoption and implementation by many countries of pro-cyclical fiscal policies. Beyond the optimistic view that the fiscal strategy has helped to reduce vulnerabilities to economic shocks, this view is surprising because in the second half of the last decade, many students have warned of the adverse and negative impact that the European fiscal rules have been generating in many European countries. In fact, in the year 2019, at the end of the year 2019, the European Central Bank itself recognized it in one of its reports, the need for countries with the best fiscal results, let's say Germany, to adopt fiscal stimulus measures to accelerate the economic activity in their economies and in the rest of country, mainly in the countries with the greatest fiscal imbalance that we can simplify saying that they were the Mediterranean countries. Although the focus of my presentation is fiscal policies in Europe, it may be useful to briefly present the main elements of the new monetary policy strategy, since because of the necessary coordination between the single monetary policy and the national fiscal policies, the reform of the former may give some signals, some clues regarding the possible changes in the framework of coordination and surveillance of fiscal policies in the European Union. In this sense, the European Central Bank had justified the change of strategy due to the problems that were affecting the effectiveness and operability of its monetary policy, which was based, as any strategy that can be defined as an inflation target, on the management of interest rates to guarantee the achievement of a medium-term inflation target. According to the ECB, what you can see in the slides were the main problems affecting its monetary policy. Of all of them, it's worth highlighting the existence of low inflation rates, that is below the level of 2%, and the fact that the equilibrium in real interest rates, those that, according to the theory, would guarantee the absence of cyclical fluctuations and price stability, could be zero or even negative. This is the latter a serious problem because the existence of a zero lower bound on nominal interest rates means that central banks cannot manage current interest rates to reach the desired level of the equilibrium real interest rates, which is something that can make or can involve that monetary policy becomes restrictive, that is pro-cyclical in a recession. Another relevant and important problem that is also highlighted by the ECB is the existence of major supply-side shocks, such as financial crisis or pandemics, both of which, due to our experience or recent experience, can no longer be considered as black swans. It was in the not so in the recent past. But instead of being considered as black swan, this can be considered more than possible, more than likely events. If these shocks occur in an environment in a context of low inflation and zero or negative equilibrium real interest rates, the possibility of monetary policy to act is dramatically reduced, which implies the need to implement other types of measures, such as, for instance, fiscal stimulus measures. Finally, we cannot forget the problems arising from the very institutional architecture of the European Union and the euro area, an architecture that generates problems related to the necessary coordination of national fiscal policies and between national fiscal policies and the single monetary policy developed by the ECB. A key element of the new monetary policy strategy approved by the ECB is the change in the inflation target. Whereas until this year, this target was defined as a rate below but close to 2%, it is now, since from July onwards, 2%, the precise figure, over the medium term, which means that the ECB is considered negative both situations in which inflation exceeds this level of 2%, and also those situations where the inflation rate is below 2%. On the other hand, the ECB is also recognizing and accepting the effectiveness on non-conventional monetary policy instruments. And actually, the ECB is incorporating these instruments into its toolkit for those situations in which interest rates are close to zero, as it is the current situation in Europe. But more relevant from the point of view of our presentation, from the fiscal policy, for the change, the reform in the fiscal policy strategy, is the acceptance of the key role by the ECB that fiscal policy can play in situations of low interest rates and severe recession, by adopting a clearly expansionary stance beyond the role that automatic or built-in stabilizers can play. This means that in these circumstances, the ECB is accepting or is demanding that economic authorities must adopt a discretionary expansionary stance of the fiscal policy. It's true that in the normal circumstances, the ECB argues that the role of fiscal policy should be based only on automatic stabilizers, which implies that for the ECB, the structural balance should be zero, at least in the long term, and that in this long term, the size of public debt should be stable, sustainable, to be more precise, according to the European jargon, so that it should be reduced from the current levels. Nevertheless, it also must be recognized that the ECB is admitting the possibility of European economies to be affected by new adverse shocks other than those that are typical of normal cyclical fluctuations. That is accepting the possibility that the European economies suffer in the future other shocks different from the usual recession of the business cycle. And in this sense, the ECB is admitting the need for an active fiscal policy in those circumstances, especially if interest rates are close to zero or zero. In this sense, the ECB is now accepting that the fiscal rules, whatever they are, should only be applied and implemented in a normal environment and not in exceptional circumstances. This recognition or acceptance is even more clear in the ECB acknowledgement that supply shocks are not a one-off exceptional event, putting some events that can put the achievement of price stability, the 2% inflation target, at risk. However, what is most striking is that the ECB is accepting the problems in the estimation or potential or equilibrium output. Something that also happens in the case of the estimation of the equilibrium employment and the unemployment rate of equilibrium, or the natural rate of unemployment, or the NIRO, whatever be the name that you use to define this, what would be the stable rate of unemployment in the long run. In fact, when the ECB is insisting on the uncertainty surrounding the estimation of these variables, as you can see in this text copied from the document of the ECB, where it shows its reform, the reform in its monetary policy. So I say when the ECB is insisting on the uncertainty surrounding that is affecting the estimation of this variable, and that the ECB is now, from this time on, not committed to any estimate of potential output or the equilibrium unemployment rate, what is being called into question by the ECB is the very theoretical foundation on which its monetary policy strategy, the inflation targeting, is based. It turns out that the ECB is implicitly accepting that it is going to decide in a discretionary manner which will be the estimate of the variable that will be used as a guide for its interventions and its measures. Let us remember that if we don't know exactly which is the level, the correct level of the equilibrium output, we cannot know what is the equilibrium real interest rate is. So there is no way to know if there is an effective lower bound in interest rates. This contradiction has implications that go beyond monetary policy and that fully and dramatically affect fiscal policy. As we will see, fiscal rules in the European Union are based on rules regarding the behavior of budget balances, but also on the behavior of structural or cyclically adjusted budget balance in the EU jargon. If we don't know the potential, if we don't know which is the potential output, we cannot decompose the budget balance into its cyclical component, that is the part of the budget balance that is based on the functioning of automatic stabilizer, and in its structural or cyclically adjusted component that is based on the discretionary measures and the impact of the discretionary fiscal measures adopted by the economic authorities. In other words, we cannot know what the fiscal policy stance is, at least the discretionary fiscal policy is, something that radically disrupts the current fiscal policy framework in the European Union and the euro area, as we will see later. Before analyzing the current framework and presenting the main features of the current framework that defines the fiscal policy strategy in the European Union, it is convenient to make a brief presentation of the theoretical and political foundations of the current framework of coordination and surveillance of national fiscal policies in the European Union. The theoretical foundations of this strategy are clearly based on neo-Keynesian economics. Thus, macroeconomic policy is based on monetary policy, specifically on inflation targeting strategies. This strategy would allow reaching economic equilibrium, matching the current activity to potential one, guaranteeing the existence of low and stable inflation rates, making inflation expectations to coincide with inflation target, and stabilizing economic fluctuation generated by demand shocks by bringing current output closer to potential output, thus eliminating inflationary pressures. Fiscal policy takes on a secondary passive non-active role, focused on avoiding potential distortions arising from large fiscal imbalances. To avoid these fiscal problems, these fiscal imbalances, it is considered necessary to abandon monetary or privileged financing schemes of the public deficit, and to finance this deficit by issuing public debt at market conditions. Fiscal policy and budget balance must be based exclusively on the working of built-in stabilizers in such a way that the generation of a structural deficit must be prevented, which means that in the long run, a balanced budget must be guaranteed. Such a strategy does not have a negative impact on economic activity as is presumed, for instance, in the classical Keynesian models. And the reason is that the fiscal policy multiplier must be or would be zero, so that expansionary fiscal policies would not have an stimulating impact on the economic activity. The reasons are the several numerous, the Ricardian equivalence, the crowding out impacts on private investment, the greater inflationary pressures, the crowding out due to the exchange rate appreciation, the existence of non-Keynesian effects, and so on. On the other hand, the expansionary fiscal adjustment hypothesis suggests that budgetary consolidation process may have an stimulated impact on economic activity, mainly if the adjustments of public deficit takes place in an environment of high level of public debt, and if fiscal adjustments comes with tax cuts, especially in the most distorting taxes, such as direct taxes on income and wealth and social security contributions. Finally, as advocated by some supply-side economists and certain approaches in the literature on the quality of public finance, there would be an optimal size of the public sector, about which public spending would negatively affect economic activity and long-term economic growth, aside that in the case of at least some European economies would have been exceeded in several countries in the past. Fiscal rules in the European Union adheres to the process of European integration, a process that is marked by a series of problems derived from the poor coordination of national policies and that translate into poor results in terms of growth and employment and unemployment. Thus, in the year 1986, the Single European Act was signed by European EU countries. The aim of this treaty was to culminate the process of European integration by achieving full economic liberalization in the year 1993. The final objective was to accelerate economic growth in the European Union, thus solving the problems of low economic growth, the so-called Eurosclerosis. This stagnation was attributed to the low degree of economic integration of the national European markets, so that progress in the integration process was considered an essential condition for bringing European economic performance closer to that of the most dynamic, advanced, and emerging economies. However, the full liberalization of the international capital movement that was achieved in 1991 gave way to the crisis of the European monetary systems in the year 1992. Full financial liberalization showed the problems of maintaining a fixed exchange rate regime without a proper coordination of national monetary and fiscal policies. It must be emphasized that from the very beginning of the process of European integration in the 50s, exchange rate stability was considered an essential element for progress in this integration process. The Bretton Woods regime guaranteed this stability, and its breakdown in the early 70s gave way to a series of initiatives to guarantee exchange rate stability in Europe, something that led to the creation in 1979 of the European monetary system. The problems of exchange rate stability stem from the autonomy of national monetary and fiscal policies, whose discrepancies led to frequent adjustments of exchange rate parities. These adjustments were not very large because of the existing controls on international capital movements. However, when in the year 1990, Germany raised its interest rates to finance the huge public expenditures resulting from the reunification process, the differences in national economic policies led to unsustainable tensions in capital and exchange markets in Europe that were exacerbated by the full freedom of international capital movements and which led to the collapse of the European monetary system. The response was the signing of the Maastricht Treaty, which raised the need to advance in the process of monetary unification to guarantee the full economic integration and liberalization in Europe. The way to guarantee the exchange rate stability was the replacement of national currencies by a single new currency, the euro. Monetary unification meant changing the monetary policy strategy by giving way to a single monetary policy managed independently by the European Central Bank, a monetary policy that was based on an inflation targeted strategy, and the setting of rules to coordinate and supervise national fiscal policy, rules that affected both the process of transition and to the transition to the monetary union and to the functioning of the monetary union when it had been created. However, monetary union did not imply a single federal fiscal policy. Fiscal policy remains in the hands of the member states, among other reasons because the competences in the field of taxation in the European Union are exclusive to the member states. The role played by the European Union budget is very small due to its small size, which cannot exceed 1.4% of the gross national income of the European Union. In fact, as we will see later, for the period 2021-2027, if we add to the EU budget the funds of the Next Generation EU program, all these resources as a whole only amount to about 3.5% of the European GDP. This implies that the European budget cannot work as an instrument of economic stabilization, a function that is left to national fiscal policy. Hence, the need to propose a framework for coordination and monitoring of this policy in order to avoid the dysfunctions and the problems that could result from the lack of coordination of these policies. Therefore, the setting of the fiscal rules in the European Union is explained by the absence or the lack of a single fiscal policy and by the potential problems arising from the autonomous discretionary management of national fiscal policies. Thus, it was argued that the discretionary management of fiscal policies could negatively affect the effectiveness on the single monetary policy. On the other hand, there was the fear that countries could implement policies that could generate an increase in fiscal imbalance, deficit, and public debt in such a way that they could become explosive or unsustainable, a problem that could be spill over to other countries through a contagion effect. To avoid these problems, the Maastricht Treaty set a series of fiscal rules to prevent the existence of excessive deficit, which could be subject to sanctions. By excessive deficit, the Maastricht Treaty meant a situation where the government deficit exceeds 3% of GDP and the size of the gross government debt exceeds 60% of the GDP. Moreover, the treaty prohibited the monetary and privileged financing of public deficit. Since then, the financing of budget imbalances became orthodox, based on the usage of debt security at market conditions. And finally, and last but not less important, the Maastricht Treaty also restricted fiscal solidarity among the member states of the European Union by prohibiting the bailout of a country, both by other European Union countries or by the European institutions. One issue under debate is related to the fiscal numerology of the Maastricht Treaty, that is, the reason behind the choice of these specific figures for government deficit and government debt. The truth is that the choice is not only an economic question linked to the need to guarantee the sustainability of these imbalances, but also for political reasons explained by the desire of some countries, mainly Germany, to limit the number of countries participating in the monetary union by tightening the conditions to access to the European Union. As shown in the transparency, the size of the public debt that allows the weight of a public debt in terms of the GDP to remain stable, that is, to be sustainable, is equal to the product of the size of the public debt by the nominal growth rate of the economy. This means that if we have a public debt of 60% of the GDP, and if the economy grows at a rate of 2% with a 3% of inflation rate, that is a nominal growth rate of 5%, we need to have a deficit of 3% to maintain this, the size of the public debt. In other words, with those nominal growth rates, the sustainability of these fiscal imbalances is warranted. It's not an anecdote that the deficit, the growth and inflation figures corresponds to the figure recorded by Germany before the signing of the Maastricht Treaty. It's important to understand the implication of these figures. If, for instance, nominal economic growth is 4%, to keep public debt constant at 60%, the public debt cannot exceed 2.4% of the GDP. And with the same growth, a deficit of 3% would imply a public debt of 75%. Why do we say that these figures were designed to limit the number of members of the euro area and the monetary union? To understand this, we must remember the two other convergence criteria. Countries could not have an inflation rate 1.5 points higher than those of the three less inflationary countries. And the long-term interest rate, measured by the interest rate on long-term public debt, should not be 2 points higher than that of the three countries with the best inflation performance. The countries with the greatest fiscal imbalances, basically the Mediterranean and Ireland, were the countries with the highest inflation. Meeting and complying with inflation criteria meant applying a very severe monetary and fiscal policy, raising interest rates and adjusting public deficit. Rising interest rates meant not meeting the interest rate criteria, and the inflationary policy would have a negative impact on economic growth. On the other hand, a severe fiscal adjustment policy would entail a drastic decline in nominal economic growth, making fiscal imbalances unsustainable. In sum, entry into the monetary union implied a high cost for the most inflationary and indebted economies. It was expected that they would join the euro much later, once these economies had corrected their internal imbalance. Therefore, it was expected that only a small number of economies, the most stable ones, would give way to the creation of the euro area. Although monetary union was initially scheduled to begin in 1997, with a majority of countries complying with the convergence criteria, the economic crisis resulting from the crisis of the European monetary system meant that by the end of 1996, only Luxembourg, just one country, met all the criteria. This moved the start of the creation of the monetary union 2 years later, in 1991, where only was required that when the monetary union could be start with the countries that met this convergence criteria. In this year, it was already clear that the launch of the euro area was going to imply a lax interpretation of compliance with the convergence criteria, and mainly with the fiscal convergence criteria. This increased the fears of those who thought that once monetary union had begun, the euro countries would relax their fiscal policy, making it difficult the coordination of the national fiscal policies. For this reason, in the year 1997, the Stability and Growth Pact was approved, setting the fiscal rules to be applied when monetary union had been formed, clarifying the circumstances under which deficit could be defined as an excessive. The pact defined the exceptional circumstances under which budgetary imbalance above the reference values could not be defined as excessive deficit, thus avoiding the corresponding sanctions, as well as the maximum admissible duration of these imbalances. Both elements that were not specified in the Maastricht Treaty. Now, according to the pact, a deficit of more than 3% of the GDP would not be considered excessive if there was a decline in GDP of more than above 2%. In the event of a growth above minus 0.75%, the deficit would be considered excessive, and between the two figures would be subject to interpretation. In any case, such a fiscal imbalance could only be maintained for just 1 year. In the case of the public debt, if the stock of debt was above 60% of the GDP, if each year the debt was reduced by 1/20 of the difference between the size of the debt and the 60% reference value, it would be not considered as an excessive deficit. The Stability and Growth Pact also stipulated that countries should achieve a budget surplus or at least a small deficit in the medium term. The fact is that the Stability and Growth Pact implied a much more restrictive fiscal policy than the one set in the Maastricht Treaty. In this sense, it's enough to understand it that between the years 1971 and 1997, the 15 countries that then formed the European Union recorded a total of 2,002 cases where the public deficit were above 3%. With these conditions set in the Stability Pact, 90% of this deficit would be considered an excessive and therefore subject to sanctions. In the year 8 years later, in 2005, the pact was reformed, obliging countries to set concrete, specific, and detailed medium-term budgetary policies. These medium-term budgetary objectives can be different for each European country, depending on different differences in the national economic and budgetary positions and developments, as well as the fiscal risk to the sustainability of public finances, including, for instance, the risk of the demographic changes. These medium-term budgetary policy objectives are set in structural terms, discounting the effects of the business cycle on government revenues and expenditures and temporary and one-off fiscal measures. These national structural balances ranges from a structural surplus to a structural deficit equivalent to 1% of potential GDP. We now must highlight that this reform is using, again, potential output as a key element in the supervision of European fiscal balances, because it is the basis to calculate structural budget balances. These variables are estimated, and the validity depends on the degree of certainty about whether we are able to calculate potential GDP, potential output correctly, and whether we can differentiate correctly between the cyclical and structural components of public expenditures and revenues. Only we know with precision, without any uncertainty, these values, we will be able to make a correct evaluation of the fiscal policy stance. So if we are suffering some or any uncertainty about the validity of this estimation, we cannot know whether the fiscal policy is expansionary, is restrictive, is procyclical, or is countercyclical. Therefore, we cannot address properly where should be the measures needed to correct the system imbalance and what would be the impact of fiscal policy on economic activity. However, the outbreak of the global financial crisis led to the implementation of expansionary fiscal policy, despite what was said in the fiscal rules in force at that time. The impact of the economic recession on the budget through the working of built-in stabilizers, the discretionary measures to increase the spending and to cut taxes, and the financial aid to banks made that the euro area in the years 2009 and 2010, the average public deficit reached 6 points of the GDP, and the public debt rose to 83% of the GDP. This deterioration in public account led the European authorities to adopt a series and to approve a series of measures related to the control and surveillance mechanism of the European budgets in order to reinforce the adoption of measures to adjust these balances. These measures are what we are usually known as the six-pack, the two-pack, and the fiscal compact. One of these measures was related to the medium-term structural budget objectives. Although these targets had been already adopted previously, the novelty lies in the fact that, in addition to being reviewed every 3 years, those countries that did not meet them should reduce or adjust their structural balances at an annual rate equivalent to 0% of the GDP, of the potential GDP, to be more precise. The new rules only allow deviation from the medium-term objective or from the adjustment path in the event of exceptional circumstances, although they were not defined. Furthermore, an expenditure benchmark or expenditure rule was set. This is according to this rule, expenditure rules, in order to ensure sustainable public expenditure restraint that is compatible with the medium-term budgetary objective. The rate of growth of public expenditure must not be above the rate of potential economic growth unless the higher expenditure comes with tax rises. The entry into force of the new fiscal rules gave way to the widespread implementation of fiscal adjustment policy that generated a sharp decline in public deficit in euro countries since the year 2011 and to a decline in the size of public debt since the year 2014. This adjustment process was led by cuts, mainly led by cuts in public expenditure. In this sense, between the year 2010 and 2018, revenues increased by 1.6 points of the GDP, and in the European Union, public expenditure fell by 4 points of GDP. And despite the caveats arising from the uncertainty about its calculation, most of the fiscal adjustment was not due to the improvement in the economic situation, but to the implementation of discretionary measures to reduce public deficit. Thus, as the figure shows, the structural deficit that was estimated to be around slightly above 4% of the GDP in 2010 fell to less than 1% in the year 2014. As a result of this fiscal policy, in the last decade, macroeconomic policy in the European Union and mainly in the European area has been in the hands of monetary policy. Thus, in the year 2011, the ECB started the process of interest rate cuts, placing them at 0% in 2016, that is this current level. It also gave way to the implementation of conventional measures as explained before. Although monetary policy has made a decisive contribution to avoid a generalized public debt, to avoid, a generalized public debt, and to save the euro, and also to stabilize the financial system and to relaunch economic activity, by the end of the last decade, it was, mentioned before, showing signs of exhaustion. Inflation rate was below the 2% target, and economic growth was really low. Indeed, in fact, in the year 2019, there was a slight worsening of public budget in a large number of European countries, a deterioration that was the result of discretionary measures adopted to increase public spending. And thus, in 21 of the 27 EU members, there was a deterioration in the structural balances of these EU countries. The opinion that the economic results resulting from the dominant economic policy strategy in Europe had not been as expected. That this economic result has not been as positive as expected began to spread. And it was also suggested that a large part of the structural problems affecting the European economies were a direct result of the fiscal austerity policies implemented in Europe. And this would be one of the reasons that explain the lower dynamism of the European economy when we compare it, for instance, to the situation of other developed and emerging economies. And also, it was, although I will try to skip, the problems, for instance, that were existing, for instance, in terms of the economic growth in the European economies, that you can see at least the evolution of the national of the GDP growth in the largest European Union economies. The problems, for instance, in terms of the, you can see the potential GDP output growth. The problems, for instance, related to the lack of a real stabilization in the evolution of the economic activity in these economies. And also, and it's a problem that is affecting to the effectiveness of the in the fiscal policy in Europe, is that one relevant and one of the most dramatic negative effect of this strategy is that fiscal policies in Europe has been characterized by a market pro-cyclical orientation, market pro-cyclical stance. This implies that European countries have tended to apply expansionary policies in face of expansion, and in times of recession, when fiscal imbalances tend to rise as a result of the recession, countries have tended to adopt adjustment measures, mainly based on spending cuts to reduce fiscal deficit. So, as you can see in this table taken from an article that has been published recently with two colleagues from a department, you can see the fiscal policy stance, for instance, in the years 1991 to 2013. And you can see, according to data, the existence of a predominance of a pro-cyclical stance that helps to understand why cyclical fluctuations in Europe have not diminished and declined since the euro came into force. On the other hand, there has been a lack of proper coordination between monetary and fiscal policy. As already noted, since the year 2011, monetary policy has been clearly expansionary, but the national fiscal policy have been predominantly restrictive. These discrepancies behind the poor economic performance in the European Union and the euro countries at the end of the last decade, and the evident slowdown in economic growth in the year 2018, which explains the ECB demands previously mentioned for a stronger fiscal policy impulse. And these poor and disappointed results can also be reflected in other variables, like, for instance, the evolution of the unemployment rates, the current and the natural unemployment rate in Europe, for instance, in terms of the rising levels of inequality and poverty, euro, and many other variables. In any case, Perhaps the main criticism to the functioning of the working of fiscal rules in the European Union is that they did not have even served to achieve the fiscal objectives for which they were designed. The objectives of a balanced budget in the medium and long term has not been achieved in the euro area in Europe. In fact, within the euro area, the existence of a deficit in excess of 3% of the GDP is far from being an exceptional event. With the exception of a small number of countries, majority of the states, including the largest one, have systematically recorded public deficit above the threshold of the 3% of the GDP, with Germany being the only exception, as you can see, for instance. And it's also, the problem is more serious in terms of the size, the evolution of the size of the public debt that has been progressively rising, moving away from the target of the 60% of the GDP. This increase would be not only generated by the evolution of the existence of public deficit, but also fundamentally and basically by the decline in the economic growth rates of the economies of the European Union in general and of the European area in particular, as you can see in the figure on the right. In this context, a wave of criticism of the role played by fiscal policies and developed economies, not only in Europe, is beginning to develop in the academic profession, advocating a much more active role for fiscal policies. And the reason to defend the revision of the review of the economic policy strategy has to do with the economic context in which they operate, based on the system of secular stagnation caused by the insufficient level of aggregate demand, by the system of very low inflation rates, by interest rates close to zero, or by the problems to guarantee fiscal sustainability, especially with regard to the size of the debt. All in all, these studies, what are recommended is a more active role played by fiscal policy, based not only on the working of built-in stabilizers, but also on the implementation of discretionary measures, increasing mainly focused on the rise of the public expenditure, and specifically in the case of what could be considered as productive public items, public expenditure items, that is, those items of public expenditure that are presumed to have the larger and more positive impact on economic growth in the long term. In this context, the outbreak of the economic crisis resulting from the pandemic has made that the fiscal rules in Europe have been suspended. In March of the last year, when the European Commission was projecting falls in the European Union real GDP of 1%, the Commission approved for the first time the activation of the General Safeguard Clause of the Stability and Growth Pact, a clause that allows states to deviate from the medium-term budgetary objectives, and therefore they are allowed to apply to implement expansionary discretionary fiscal policies with the main objective to mitigate the economic impact of the COVID-19. And it is also important to notice that although this clause was approved in the year 2011, it was also thought, given the experience of the global financial crisis, that in some circumstances, that are exceptional circumstances, these fiscal rules should be suspended, and and the countries could and should be allowed to implement expansionary fiscal policies, but only under exceptional circumstances that at that point were not considered to happen as soon as it took place. The activation of this clause implies that fiscal rules in the European Union are nowadays suspended. Although the European Commission expects to deactivate the clause at the beginning of the year 2023, however, the bad economic forecast presented 1 month ago does not rule out the possibility that it can also continue to be implemented, to be applied in the year 2023. At the same time, simultaneously, in March 2020, the restrictions set by the European treaties on public aids given to companies were suspended, so that the states could grant direct aid to the companies and sectors more affected by the crisis. On the other hand, the European Union approved a series of programs aimed to mitigate the economic effect of the pandemic. Among them, the SURE program, aimed to finance the different measures to support the maintenance of employment in the European countries, mainly through the different short-time work schemes, and the Next Generation EU program stand out. The Next Generation EU program is the start of the European programs aimed at relaunching economic activity during the pandemic, both in terms of its amount, this 750 billion euros at 2018 prices, its distribution between countries, with the countries most affected by the economic crisis receiving a greater share of the revenues of these funds, and the composition of the programs, aimed primarily at financing public investment projects in areas such as the ecological transition, digitalisation, innovation activities, climate change, and so on. It must also be emphasized that 52% of the program budget is granted to the states in the form of subsidies, that is the grants, and 48% in the form of loans. This means that most of the resources obtained by the countries, and therefore the expenditure they finance, do not lead to increases in the deficit and public debt, thus alleviating the serious financial imbalances suffered by most European countries. On the other hand, the financing of this program does not come from the budget, the own resources of the European Union, but it is obtained through the EU's borrowing the capital market. So these resources are complementing what would be the European Union expenditure for the period 2021-2027, that amounts to more than 1 trillion euros. On the whole, the measures adopted by the EU in itself represent a progress in terms of a promotion of the active, or an impulse of the active use of fiscal policy to stabilize the European economy and even to stimulate those expenditure items that are most likely to promote economic growth in the long term. Another positive assessment derives from the fact that its design and operation is built on the principle of solidarity between European countries, since the bulk of the new economic recovery programs and instruments are mainly aimed at those countries that were most affected by the crisis. For instance, like this is the case of Spain. However, this action is not without clear limitations. On the one hand, the recovery programs and instruments are of a temporary and exceptional nature, linked to the existence of the pandemic's economic effect. This implies that they are not intended to be permanent, what raises the uncertainty as what can happen in the event of a new extraordinary shock that affects European economies. And there is doubt about there will be the necessary consensus to support and implement similar programs in these potential future negative events. On the other hand, the size of the programs is only apparently very large. However, these programs have a multi-annual dimension. It will be operative during the next 5 years. And thus, in the specific case of the Next Generation EU, the total volume of the resource barely reached the 5.6% of the European GDP in 2019. So it means that each year this program will represent resources of less than 0.6% of the EU GDP, an amount that is clearly quite small. Moreover, in the case of the European Union budget, it will maintain a small size, although it's been discussing a possible enlargement based on new resources to finance the EU budget. It will not be able to reach the required size to fulfill a stabilization role similar to that of other federal or central budgets in the member states or in other countries. On the other hand, the EU budget is still based, as stated in the European treaties, on the prohibition of running a deficit, which further limits its potential role as an stabilization instrument. Taken together, these factors imply that the stabilization role of fiscal policy remains and will remain in the near future in the hands of national countries. The data in this table, taken from a recent article that I published with Professor Felipe Serrano, so how European fiscal policies, national fiscal policies, have acquired the market expansionary orientation in the year 2020 and in this current year. An orientation that is based not only on the automatic effect derived from the automatic stabilizers, but mainly on the discretionary measures adopted by the national authorities, especially in the side of the expenditures, mainly in terms of the spending on aid to companies, the aid to support employment, the unemployment benefits, and the health, is in a rise in the health expenditure. This increase in public expenditure has translated into higher public deficit, with the result that this year only Cyprus, Luxembourg, Denmark, and Sweden will have deficits that are estimated to be below the level of 3%. As far as public debt is concerned, the size of debt has increased without exception in the European Union, and only 10 countries have a debt stock below 60% of the GDP. And it must be noted that this means that out of the 19 countries in the euro area, 15 countries have a public debt above 60% of the GDP, and that out of the 8 countries that do not belong to the euro area, only six out of these 8 countries have below this limit. The non-compliance with the deficit and public debt data is reproduced in the case of the structural deficit. According to the estimation that are shown in the slide of the recent economic forecast of the European Commission, only Luxembourg, Denmark, and Sweden will have in the year 2023, that is in the 2 years, structural surpluses, which would require the adoption of discretionary measures to correct these imbalances. We must remember that the latest economic forecast published by the European Commission implying a worsening of the forecast of economic growth is creating some lot of uncertainty about the capacity of the different national countries to fulfill their objectives related to the public finances, and that are creating some uncertainty about what will be the likely evolution of the fiscal deficits. In this context, the possibility to comply with the deficit and public debt criteria is simply non-existent, is zero. In this figure, I am showing the different scenarios I have constructed related to the evolution of public debt in a single country like Spain, based on the data on primary deficit, the average interest rates on public debt, the economic growth rates, and the stock of public debt. Only in the most optimistic scenario, that in blue with the capital letter G, would public debt be on a declining path. This scenario, this positive scenario, would be characterized by a primary surplus of 2.8% of the GDP, an average debt interest rate of 3%, GDP deflator of 0.5%, and economic growth and a rate of growth of the GDP of 3.5%. It should bear in mind that Spain's forecast for 2021 were for a primary deficit of 5.9, almost 6% of the GDP, and that the GDP growth 2 years ago was only 2.1%, which speaks clearly of difficulties in achieving these figures, even the difficulties for Spain to be embarked in a path of declining size of the public debt. Indeed, even in this optimistic scenario, we should wait until the year 2039 for the debt to fall below the 60% threshold. A similar situation takes place when we analyze the evolution of the primary budget balance that would be necessary for Spain to reduce the excess public debt by 120% of the excessive public debt asset in the stability and growth curve. So here we have estimated 2 different scenarios. The scenario E, we assume that we make, in this sense, in a scenario defined by the real interest rate on public debt of 0.8%, which would be the rate estimated by the European Commission for the year 2023, and that the GDP growth will be again 2.1%, that recorded in the year 2019. In the scenario B, the real interest rate will be that of the year 2018, a little higher, slightly above 1%, and the growth rate will be the potential growth rate estimated for 2019. The main conclusion of this exercise is that in none of these cases, the public debt limit of 60% will be reached in the year 2070, remaining in all cases at the 60% of the GDP. In the first scenario, the most optimistic, reducing the debt by 120 would be implied that the Spanish primary budget would record surpluses until the year 2044. In the scenario B, the pessimistic one, Spain should record budget surpluses until the year 2020. Recall that the Commission estimates that in 2023, Spain will record a primary deficit of 2.1%. Well, according to our simulation, the primary surplus will be in 2024 1.3 or 2.8% of the GDP, depending on the scenario. In other words, in the year 2024, the fiscal adjustment in Spain necessary to start reducing the public debt following the current fiscal rules will range in our simulation between 3% of the GDP and 5 points of the GDP. An enormous adjustment that, without a doubt, would seriously damage the Spanish economy. It's clear that the current fiscal rules are impossible to apply, not only in the current context of economic crisis and post-COVID recovery, but also in a longer term. And this happened also in a scenario of a stable and sustainable growth. If the recovery of the European economies were slower than expected, or if in the short and medium term they were to suffer a new adverse shock, it's obvious that the validity of the current rules will be again null, not only because compliance with them could have serious negative effects on the economic growth, but also for a simpler reason. They cannot be complied with. This requires a reformulation of the strategy of coordination and surveillance of European fiscal policy and a profound and in-depth revision of the current fiscal rules. In this regard, various academic and EU institutions have expressed their views in consideration on the ongoing reform of the governance framework for tax policy in the European Union, all of them with a view to achieving a substantial reform of fiscal rules. Where should this reform go, of the current fiscal rules? In my view, the new rules that must be in place, which is something that is inevitable, given that fiscal policy will remain in the hands of the member states, European states, should give greater weight to public debt. Unlike the current framework, we are definitely rules were de facto or are de facto the centerpiece of the fiscal policy strategy. These rules should be based on setting a higher limit on the size of public debt that is currently the case, perhaps say 100% of the GDP, and pay greater attention to the issue of public debt sustainability in the surveillance of fiscal policy and to the process of adjustment, especially for the most indebted countries, towards a smaller public debt size that gives countries a cushion or room of maneuver to implement expansionary fiscal policy when it's necessary. On the other hand, limits on the size of public deficit should be individually tailored to national growth rates instead of having the same limit for all the countries, regardless what is the situation, the current and long-term situation, or in terms of the GDP growth, while at the same time being adapted to the size of public expenditures or other expenditures that could be considered as productive, thus giving rise to a sort of some kind of golden fiscal rules. In this sense, these criteria should also again take into account the different size of public debt stocks, being stricter for those countries, for instance, like Spain, that have an excessive public debt and that is currently well above 100% of the GDP. Moreover, in my opinion, the existing references in these rules to structural balances of potential OPEX should be eliminated, given the existing uncertainties, as is recognized by the ECB, about the validity of this kind of estimates, about potential output or potential GDP growth or natural rate of unemployment. The new rules should also avoid the procyclical stance of fiscal policy, except obviously in the case where fiscal policy must focus on reducing the size of public debt, thereby ensuring the effectiveness and functioning of fiscal policy as an instrument of fiscal stabilization in EU economies. Finally, there should be elements to ensure an adequate coordination between monetary and fiscal policies, so as to guarantee the effectiveness of both measures, contributing to less volatility and instability in European economies. On the other hand, these reforms of fiscal rules should go hand in hand with a larger EU budget, which should be accompanied by the design of programs and instruments similar to those applied during the current crisis, in which, like this, should be financed by public debt issuance by the European Union, allowing the EU budget to act as a proper stabilization instrument, which would be especially useful both for the states most affected by a common shock affecting the whole European Union, and for those states that nowadays have less room for maneuver to apply expansionary national fiscal policy. To conclude, and this is my last presentation, the end of my presentation, on the current fiscal policy is clearly expansionary and countercyclical. This situation can only be seen with the current existing rules as a temporary and exceptional situation. Despite the rising consensus on the need to reform fiscal rules in force, it's not clear that there is a political will in Europe to radically reform them, because of the lack of consensus among countries and the need to approve any reform with unanimous support of all the European countries. And that's, to be honest, in my opinion, the medium and long-term economic outlook in the media about a radical reform in the current fiscal rules is far from being optimistic. However, it's also true that there is a widespread fear that the fiscal situation of European countries may be worsened in the event that the economic recovery is finally slower than expected, that the cost of the public debt may rise, especially if the expansionary stance of peak monetary policy changes and the ECB starts to taper or withdraw its asset purchase programs or rises official interest rate, or more seriously, if European economies suffer a new episode of supply side or demand side shock. This fear may accelerate the reform of fiscal rules. And this is something that is desirable. Otherwise, the current exceptional situation would turn into a new normal, which would imply a de facto repeal of these rules. So this is my intervention. Thank you very much for your attention. And I open to any comments, questions, or suggestions that you may have about this presentation. Thank you very much.
Sorry. Thank you so much, Jesus, for your brilliant presentation. Well, I will. Don't know, Luiz, if you collect questions in the, I don't know where is presenting the seminar and collect questions. Well, I will do some brief questions, comments, actually more. There are no questions. Okay, no questions up to now. Okay, I will do some comments, not exactly question, but comments. Well, it seems to me that from your presentation that the problem of European Union, there are two sorts of problems that is somehow related. One that is your main focus is about the fiscal rules. The fiscal rules, it's necessary to change, to reform the fiscal rules. And the second, that's somehow related, is the fact that the GDP growth of Euro area is lower compared to other advanced economies, with the exception of Japan. So, of course, this has impact on the fiscal variables. And well, my first question is that do you suggest that the fact of this lower performance, GDP performance of the euro area is related to this lack of coordination between monetary policy, fiscal policy, the fiscal rules, or there are something else? One point that I would like to hear you is that there are a lot of empirical works about fiscal multiplier that show that public expenditure related to public investment, mainly in case of infrastructure, even in mainstream, IMF has some studies about this, show that it has a much higher multiplier effect in the economy. And of course, we could. I know that we don't like to use this concept of product output, natural output, but of course, if it is increase the longer term economic growth as well. I'd like to hear you about this. The other point is that you mentioned that about programs related to face the COVID-19 in Europe. It was there implement a lot of programs, but it was somehow reduced size. One of the limits was the reduced size of the budget. And I'd like to hear reduced size of the budget compared to what? Compared, for instance, compared to United States, compared to United Kingdom. I'd like to hear you different performance in comparison with other advanced economies. And finally, I'd like to hear you also about two more questions. One is that is it possible to have a good coordination of monetary and fiscal policies without a supranational fiscal policy? Is there any alternative for that can work well, maintaining the fiscal policy in terms of the local government, or it is necessary a supranational fiscal policy? Finally, it's just a comment that all this discussion for us in the periphery, as we are in Brazil, sounds very, very different, because we are in Brazil in I think that in Latin America, most Latin American Paleolithic period, that the discussion here is very different. That is there is no change in the orthodox economic policies, or this belief of the balanced fiscal equilibrium, and so we are central banking is after the COVID-19 returning to the very conventional monetary policy. We in Brazil, we have this fiscal expenditure cap. There are different fiscal rules. There are golden rule. There is primary fiscal targets, and there is this all this. So the policy space to implement fiscal counter-cyclical fiscal policies is very, very, very reduced. So we are. That's just. I know that is not your presentation. It's just for comparison. Actually, I'd like to hear about the other points that I point out. Thank you.
Thank you very much, Luis Fernando. Well, regarding your comments, for instance, starting from your first comment, one problem that we have that explains, for instance, the fact of the low, the poor dynamism of the European countries and the unsatisfactory low rates of economic growth, as I mentioned, has to do with the fiscal policy. And it has to do with the fiscal policy in this sense, because it not has only focused on the implementation of a systematic, for instance, in the last years, in the year 2010, of tight fiscal policy focused on the reduction of public deficit. It has also to do with the composition of these adjustments. Precisely in most of the countries where that have succeeded in reducing fiscal deficit, this strategy has been based on the reduction and decline in public expenditure. Precisely in those categories of spending of expenditure that the theory agrees that has the highest can be more beneficial from a long-term perspective, that have the greatest impact in terms of the economic growth in the long term. We are talking, for instance, on some categories, for instance, related to public investment in infrastructures, in expenditure, for instance, in education, in investment in categories like health, and other social spending items, that there is a generalized consensus on the positive impact on this economy. So by focusing on these elements, by reducing the size of this element, this has also been effective to the path of economic growth in the long term. Besides, we cannot forget other channel of transmission of this tight fiscal policy. It has now there is starting to be a broad consensus that related to the fact that the income inequality can be also a source of the poor performance of economies. So that the higher income inequality, especially for instance in terms of an increase in the income inequality in personal terms, or the strong decline, for instance, in the wealth share, may have a negative impact on the economic growth in the long term. And precisely more, now there are a high number of studies that are showing precisely that austerity policies has affected negatively, in a negative way, to the income distribution and, for instance, to the existence of a high share of, for instance, higher poverty rate, of a strong decline in the economic, in the wage share in all the European economy. So this can be another source that explains the poor economic performance in the European Union. As you say, there is also a lot of papers that argue against the austerity policy because of the existence of multipliers, positive multipliers, and positive multipliers be above 1%. The problem is that when the fiscal rules were set in Europe and the European Union, there was a broad consensus, at least in the orthodox economy, that fiscal multiplier could be close to zero or even negative. So it was taken for granted that fiscal austerity, that the fiscal adjustment process would have no negative impact. The problem is that precisely in Europe, we started to notice that this assumption was mistaken precisely with the crisis, the debt crisis in Greece, where all the economic institutions, European and non-European, were recommended a strong fiscal adjustment and a strong decline in the public disequilibrium in Greece. And suddenly we discovered that with the suggestion and measures adopted by the Greek authorities that imply a cut in only 1 year of cutting public expenditures above 5% of the economy, we realized that the negative impact of this kind of measures were enormous. And we still have the consequences that the GDP, the Greek GDP decline in a couple of years are more than 25%. So then is when we realize that the multipliers were not so low as we expected, that they were even positive. However, and as I mentioned, in the period 2012-2030, the only institutions that did not take into account this fact were the European Union, because we approved new reforms in the fiscal rules that were precisely trying to favor the implementation of this fiscal adjustment. And this is, as we will consider that well, the problem of the Greeks was an exceptional problem related to the problems of the Greek economy, and that it would not be translated to other economies. Now, obviously, we are now in a situation where probably this acceptance of the zero multiplier, I think, has no support at all. Regarding the EU programs, as I mentioned, the truth is that the small is not very large. Indeed, the expansionary stance, the rise in the public debt, and the rise in public expenditure in Europe is not based, or has not been based on the EU programs, but on the implementation of national programs to raise public debt. You must notice that this is now in this year when the Next Generation EU is starting to be operative, because the funds of this, in the case, for instance, of Spain, it's assumed that we will get around 100 billion euros, but during the period of 10 years. So, for instance, in our case, we have just received the first part of this aid, that is around 10, only for this year, 10 billion euros. Nothing else. It's less than 1%. However, the Next Generation is important, not so much in terms on its contribution to the economic recovery in Europe that is taking place now, but it's important because it's a source of funds, of revenues, that could allow to the countries to maintain the public expenditure without significantly adjusting some categories of public expenditures related, for instance, to some categories of social expenditures and public expenditures. So in this sense, the main contribution is that we will be able to simultaneously implement a policy of declining public debts without negatively affecting the size of the productive public expenditures. So this is the main advantage of these programs. And finally, yes, as you say, the problem is that we need desperately a European budget. Something, a category or something different that we have now, that can act as an stabilization mechanism for the whole European Union and for the whole European in the whole euro area. Because in this sense, it can be easier to get the desired coordination between fiscal and monetary policy, between a single monetary policy and a European fiscal policy, because the problems to coordinate the 27 national fiscal policy are evident and are very difficult to comply with. And finally, yes, I think that from the perspective of the Brazilian, of course, it's clear that the European macroeconomic policy is radically heterodox. It is based on an unconventional monetary policy. The President Christine Lagarde of the ECB has already announced that the next year they will not touch. There will be no rise in interest rates. There will be no tapering of the different programs of purchase of financial assets, and it's also warning all the time, permanently warning on the need to maintain the current fiscal impulse, and they are warning about the dangers of a strong decline and strong adjustment in the case unless a substantial recovery has been reached. So obviously we are maintaining a strategy of economic policy, monetary, but also fiscal, dramatically different from that, for instance, that is being currently implemented in countries like Brazil.
Okay, thank you, Jesus. And Luis, is there any question from the public in general? There is. Okay. Still no question. Okay, so we can, it is 12. It's time for lunch in Brazil. It's that exactly. And so thank you so much, Jesus, for your presentation, for the discussion, and hope that the next time we will be present here in person, not virtually. So okay, thank you so much.
Thank you so much. It has been a pleasure. And again, thank you very much for your invitation. Thank you.
Okay.